We'll be looking at a couple of different budgets for the chapter on master budgeting. And so I want to start with a cash budget, and then I'm also going to do a production budget. They're similar, but they're enough different that I want to talk about both of them. And so let's just say that we have a cash budget, and when you see these, and when you work on these in your career, generally you'll see them by month or quarter. And so we're going to set this one up by quarter. And one thing to keep in mind um, with your cash budgets, yeah, I think this is the one I want to do. I started to change my mind, but now I'm going to go ahead and do this one. You have cash receipts and you have cash disbursements. And often companies will be required by their bank to have a minimum balance. And if they do have to borrow, they should know what their interest rate is. So this company will say has to have a minimum balance of $10,000, and they have a 3% interest rate. Okay, so we have all of our information: cash receipts, cash disbursements, minimum cash balance, and the rate we borrow at. So we'll start with our beginning cash balance. And one reason I want to do this is because a common mistake I see with students, I don't think it happens in the workplace, but I want to show you a common mistake I see. So we have cash receipts and cash disbursement. So we'll go ahead and call this total cash available. And then we have financing. So we have an amount borrowed if necessary, and we have an amount repaid if we have excess. And then we have our ending cash balance, which will become our beginning for the second quarter. And sometimes I will see people put totals out here, which is fine, but I want to show you something with that. So our beginning cash balance is $25,000. And our cash receipts, that's given to us. So our total cash available is just the two added together. And then our cash disbursements is also given to us, $365,000. And actually probably need to put a line right here. And I'm going to call this excess cash. And my excess cash would be my total cash available minus my disbursements. Now, if I have a negative right there, then I'm going to need to borrow some money, which I need to borrow some money. And so my minimum balance is $10,000, so I need to borrow $40,000. And then my ending cash balance, I think I can set this up with formulas, is $10,000. So my beginning for the second quarter is my ending for the first. And then I have my cash receipts. I have my total cash available minus my cash disbursements. And then I have some excess cash, hopefully. So I have $105,000. So I can go ahead and pay back this $40,000. Now, there's this little thing called interest. And so let's talk about interest. So probably need to add another line here because I forgot. And this is my interest payments, because the bank is not going to let us borrow that money for free. Now, in real life, you would have an amortization schedule, and as you borrowed the money, you would accrue interest, and the bank would calculate that for you. But for your homework, I'm going to explain to you the way that Connect calculates this and how your book would calculate this. So in theory, you're doing a cash budget and you're looking ahead. So I can see in the first quarter, I'm going to need $40,000. And I can see at the end of the second quarter, I'm going to have $40,000 to pay back. So it's going to be $40,000 times 3%, because it's 3% per quarter times 2, because you borrowed it at the beginning of the first and paid it back at the end of the second. And that's why it's set up that way. So we subtract what we paid back, and we have $62,600, which is our beginning balance. And I'm going to continue to kind of show you how this is set up, because I want to show you the common mistake I see with totals. And so at the end of the third quarter, we have excess cash of $97,600. We don't have to repay anything. We don't have to borrow anything. So we start the fourth quarter with that amount. We have cash receipts. We have cash disbursements. Again, we don't have to pay anything. And so we have $132,600 left over at the end of the year. Now, if I'm doing a total, my beginning cash balance is my first quarter beginning cash balance. My cash receipts is a sum of all 4 quarters. My total cash available is these two added together. My cash disbursements are my entire year. And then my excess cash did that wrong. I knew that didn't look right. There we go. Is $135,000. Now, why doesn't that match that amount? It's because I've got to go down here and show this interest that I paid, and then I've got my $135,000 minus my interest that I paid, or $132,600, which is ending for fourth quarter. A lot of times I'll still see people on your total. You'll take this beginning fourth quarter. Don't do that. Be real careful that you're looking at this as the year. Okay, now I want to look real quickly at a production budget. And so the way a production budget works is we have beginning inventory and we have ending inventory. And so we want to make sure that we look at our inventory the way that we should. And this problem I'm going to look at is actually going to look at production and then also look at direct materials. So the way you want to set this up, and if you have a book, I highly recommend that you set these up the way the book does, because it will help you as you go through these problems. And so, let's see. There's a production budget on page 418 in your textbook, Schedule 2. And what we want to show is budgeted unit sales. And then we want to have desired ending inventory, because most of the time we need to have some ready for next quarter or next month or next week, whichever one we're looking at. And then we had some in the beginning, so we less our beginning ending inventory. I'll explain this as we go through it. And then we have our required production. And then we have to do direct materials, but this just gives us our production. So this is a way to get started with this. And we start with our sales, because obviously we need to produce what we're going to sell. So I'm going to go July, August, September, October, November, December. So we're doing a monthly budget, and we've got our sales, 35,000, 40,000, 50,000, 30,000, 20,000, and 10,000. That's our sales. It's given to us by our sales department. And then we have to know what our policy is. And so you've got to know what your desired ending inventory is. And so what this company says is they want the finished goods inventory on hand at the end of each month to be 3,000 units plus 20% of next month's sales. So policy, 3,000 units plus 20% of next month's sales. So what we want to end July with is 3,000 units plus 20% next month's sales. And I don't know why that is so far off. Let's try that again. 3,000. Oh, I know why. Plus, I didn't put a plus right there. 20%. There we go. 11,000 units. And these are units, so they don't have decimals. And so our total will be the sum of those two. So we need 35,000 we're going to sell. We need to produce 11,000 more, so we have 46. But we began the quarter with something. And that's actually given to us. It was 10,000. And if you look, that would be your 3,000 plus 20% of that. So my required production is what I need minus what I started the month with. And I just did a circular reference. Hang on. I was in the wrong column. Okay, there we go. And then I should be able to carry that over, except my beginning is going to be my ending for the previous month. Well, let's see if I can make that work. It's always scary when you do this on a video. So I think we're good there. So I've got my required production, and you can go in and check all that for your benefit. But then we have direct materials purchases, because not only do we have to produce that, we have an inventory for direct materials. And so it tells us that we want our raw materials to be, and this is our policy down here, policy for raw materials. We want our policy for raw materials to be 1/2 of the following month's production needs. And then we have to know how much we need for each unit. So that's the other information that you need. And so in order to produce one of these units up here, this direct materials that we're looking for, we need 3 cubic centimeters per unit. So that's really important. So again, we have our budgeted needs. We have our desired ending inventory. We have our total. We have less beginning inventory. And we have required purchases, not production, because we're purchasing direct materials. And so this is going to be driven by our production, because we need 3 units for what we're producing. So I would probably, just because I really like to use Excel, I try to set things up in formulas as much as I can. And when I use something like that I'm going to use over and over again, you want to have it in its own column. And these are units. And so we want to set it up that way. And so I need my future amounts in order to calculate this. So my desired ending inventories, I want 50% of the following month's production needs. So I need 50% of the following month. I need that in my ending inventory. So my total, and then my less my beginning. And we can calculate that, but it's also given to us 54,000. Which is half of next month's needs. I'm sorry, half of this month. And so our required purchases are what we need minus what we already had, or 117,000 cubic centimeters. So if I did this right, I'll be able to carry this forward. And you can see, oh, I didn't do this right. Beginning is last month's ending. I didn't set that up right. So let me fix that. There we go. And that should give you your required purchases for direct materials. So go back over that and make sure you understand what I did.